Warren Buffett has long been recognized as one of the most influential voices in the world of investing, especially when it comes to navigating market volatility. His approach centers on timeless principles that help investors maintain composure during uncertain times. Rather than reacting to short-term market swings, Buffett encourages a focus on the underlying strength and value of businesses. As he prepares to step down from Berkshire Hathaway, his guidance remains as relevant as ever, offering stability and perspective to those seeking to build long-term wealth. By emphasizing fundamentals, patience, and a disciplined mindset, Buffett's strategies continue to serve as a reliable foundation for investors facing today's unpredictable markets. Warren Buffett has built a remarkable legacy as one of the most influential investors of our time. As the long-serving CEO of Berkshire Hathaway, he transformed the company into a global powerhouse, renowned for its disciplined investment strategies and consistent growth. Buffett's philosophy of value investing and his commitment to business fundamentals have inspired generations of investors. Now at 95 years old, he is preparing to step down from his leadership role in January 2026. This impending retirement marks the end of an era, but his principles and approach will continue to shape Berkshire Hathaway and the broader investment community for years to come. Focusing on business fundamentals is a cornerstone of sound investing. By understanding a company's core operations and financial health, investors gain insight into its true value and long-term potential. This approach encourages looking beyond short-term market swings and daily price fluctuations, instead prioritizing the intrinsic qualities that drive sustainable growth. Evaluating factors such as revenue streams, profit margins, and balance sheet strength helps build a solid foundation for investment decisions. When investors concentrate on these essentials, they are better equipped to identify resilient businesses and avoid unnecessary risks. Ultimately, a disciplined focus on fundamentals can lead to more confident and informed choices in any market environment. Assessing the intrinsic value of a company empowers investors to focus on its true financial health and long-term prospects, rather than being distracted by daily price swings. By understanding what a business is genuinely worth, investors can make decisions rooted in solid fundamentals, rather than reacting impulsively to market headlines or volatility. This approach encourages patience and discipline, helping investors avoid the pitfalls of short-term speculation. Warren Buffett has long advocated for this strategy, emphasizing that a clear grasp of intrinsic value allows one to see past temporary market noise. Ultimately, prioritizing intrinsic value leads to more informed choices and greater confidence, even during periods of uncertainty. Warren Buffett is a strong proponent of long-term investing, emphasizing that holding stocks for decades can be a powerful strategy. By maintaining a long-term perspective, investors are better equipped to weather short-term market fluctuations and avoid making impulsive decisions during periods of volatility. Over time, quality businesses tend to grow and their value compounds, leading to significant wealth accumulation. Buffett believes that patience allows investors to benefit from the natural growth of companies and the effects of reinvested earnings. This approach also reduces the stress and uncertainty that often accompany frequent trading and market timing. Ultimately, long-term thinking aligns with Buffett's philosophy of focusing on the enduring fundamentals of a business rather than reacting to daily market noise. Maintaining cash reserves provides investors with a crucial strategic advantage, especially during periods of market volatility. Liquidity allows for flexibility, enabling investors to act quickly when opportunities arise. During market downturns, having cash on hand means being able to purchase quality assets at discounted prices, while others may be forced to sell or sit on the sidelines. Warren Buffett often emphasizes the importance of this approach, noting that cash reserves can serve as a buffer against uncertainty and a tool for seizing favorable investments. By prioritizing liquidity, investors position themselves to make thoughtful decisions rather than reacting out of necessity. This disciplined strategy helps to mitigate risk and maximize long-term returns. Warren Buffett has consistently warned investors about the dangers of using debt to finance investments, especially during periods of market volatility. Leveraging can amplify both gains and losses, but when markets turn unpredictable, the risks of borrowing become even more pronounced. Buffett emphasizes that debt can force investors into making hasty decisions under pressure, often resulting in significant financial setbacks. By avoiding leverage, investors can maintain greater control over their portfolios and reduce the likelihood of emotional reactions to market swings. This approach aligns with Buffett's broader philosophy of prioritizing financial stability and long-term growth over short-term speculation. Ultimately, steering clear of debt helps investors weather market turbulence with confidence and resilience. Warren Buffett's well-known principle of being fearful when others are greedy and greedy when others are fearful highlights the importance of understanding market sentiment. When optimism runs high and investors rush to buy, prices can become inflated, increasing the risk of losses. Conversely, during periods of widespread fear and selling, quality assets may be undervalued, presenting unique buying opportunities. Buffett encourages investors to remain calm and objective, resisting the urge to follow the crowd. By recognizing how emotions drive market movements, investors can make more rational decisions and potentially benefit from moments of panic or exuberance. This disciplined approach helps to uncover value and avoid the pitfalls of herd mentality. Warren Buffett encourages investors to approach the stock market with the mindset of a business owner. Rather than treating stocks as mere numbers on a screen, he suggests viewing each share as a stake in a real company with its own operations, challenges, and growth potential. This perspective shifts the focus from short-term price fluctuations to the long-term prospects and health of the business itself. By understanding the fundamentals and future trajectory of the companies you invest in, you can make more informed decisions and remain resilient during periods of market volatility. Ultimately, thinking like a business owner helps investors maintain discipline and confidence, even when the market is unpredictable. Warren Buffett consistently emphasizes the importance of knowing what you own when investing. This principle centers on staying within your circle of competence, which means focusing on businesses and industries you truly understand. By thoroughly researching and grasping the fundamentals of your investments, you can make informed decisions and avoid unnecessary risks. Understanding a company's operations, financial health, and long-term prospects helps you assess its true value, rather than being swayed by market hype or speculation. Investing in familiar territory not only boosts your confidence, but also enhances your ability to respond wisely during periods of market volatility. Ultimately, Buffett believes that disciplined knowledge is the foundation of successful investing. Berkshire Hathaway has recently reported record cash reserves and rising profits, reflecting Warren Buffett's signature cautious approach as he prepares for his departure in January 2026. These developments signal a strategic emphasis on liquidity, allowing the company to remain flexible and ready to seize opportunities during market downturns. Buffett's decision to maintain substantial cash holdings demonstrates his preference for stability and prudent risk management, especially in uncertain times. This approach not only safeguards Berkshire Hathaway's financial health, but also positions it to capitalize on attractive investments when others may be retreating. As Buffett transitions leadership, these measures underscore his commitment to ensuring the company's resilience and long-term success. Warren Buffett has expressed strong confidence in Greg Abel, his designated successor at Berkshire Hathaway. As Buffett prepares to step down, he has made it clear that he intends to retain his shares in the company, signaling his trust in Abel's leadership and the ongoing stability of Berkshire's investment approach. This decision reassures investors that the core principles Buffett established will continue to guide the company. By maintaining his stake, Buffett demonstrates his belief in Berkshire's future and the enduring value of its long-term strategies. The transition is set to uphold the disciplined, fundamentals-based philosophy that has defined Berkshire Hathaway for decades. Investors facing today's market volatility can benefit greatly from Warren Buffett's enduring principles. By focusing on a company's fundamentals rather than reacting to daily price swings, individuals can make decisions rooted in long-term value. Buffett encourages holding investments for decades, allowing time for quality businesses to grow and compound returns. Maintaining cash reserves is another key strategy, providing the flexibility to seize opportunities when markets are down. He also warns against using debt to invest, as leverage can magnify losses during turbulent periods. Viewing stocks as ownership in real businesses and investing within one's circle of competence helps maintain confidence and clarity. By applying these strategies, investors can build portfolios that are resilient and better equipped to weather uncertainty. Warren Buffett's enduring wisdom offers investors a clear roadmap for navigating market volatility. By focusing on business fundamentals, maintaining cash reserves, and avoiding excessive debt, investors can make sound decisions even in uncertain times. Embracing a long-term perspective and thinking like a business owner helps to minimize the impact of short-term market swings. Buffett's advice to be cautious when others are greedy and opportunistic when others are fearful remains as relevant as ever. By thoroughly understanding your investments and staying disciplined, you can build a resilient portfolio that stands the test of time. Adopting these principles can help investors achieve greater confidence and stability in their financial journey.